Hello everyone, it is Evan from the Trade Risk here on Wednesday, January 6th with a market recap video. We are first going to analyze the current market environment. We're going to look at some other markets, leading and lagging sectors, and then get into some individual names. No trade ideas in this video. Now let's jump in. We got a lot to talk about. Happy New Year. It's been a tough new year for the stock market so far. We were down 1.26% in the S&P 500, and that is a total of 2.5% down on the year. Approximately. So let's take a look at what happened here this Monday. So this was the first trading day of the new year. We started off with that gap lower, and that right away gave you and kind of set the tone that perhaps raising the flags a little bit, perhaps something is changing. We gap lower by 1.5%. Now, the positive side on that gap was that we did find some support below 199. You could see the way we closed here with this reversal looking bar, and it was happening at this previous level of support, of important support here that the market has demonstrated right around 199 to 200 in the SPY. So that left you maybe a little bit optimistic, but of course we still had this gap down. We were still below all the fast moving averages. Yesterday, not much changed. The bulls managed to keep some of that progress, got a little bit of follow through. Again, you see some of the tail here on the bottom that the buyers did step in as price tried to get back below 200 yesterday. But unfortunately, again, we were hit with another big gap lower to start off today. And now the support and the resistance and the layers of supply are now just building above this market. So while we are now below 200 and 199, the fast-moving averages are racing lower. I think you still need to remain pretty defensive here. I'm not so sure that this is the best spot to initiate new shorts. I think we are stretched a little bit to the downside now. You can see how far away we are from some of these fast-moving averages. So perhaps we can chop around. Perhaps we get some type of bounce tomorrow. But regardless, I think the intermediate, the character here of the market is changing. And I think until we can get back above, really this level here, which is now I'm drawing resistance here at 202, I think that's certainly the first hurdle. Close this gap, get back above these fast moving averages, work itself back into this range from late 2015. That's certainly the first step to get a little more optimistic if you are an interested buyer here. I think that's what you'd want to see first. I think right now the market's very vulnerable. It needs to prove itself right now. The bears definitely have the upper hand, so I think you need to be careful there. So there's a little something for everyone. It looks like it's going to be a tough market over the next few days. At best, we're going to chop around and probably try and shake both the aggressive short sellers and the eager buyers out of their positions while the market kind of finds its footing. Otherwise, though, I do think, as the market's suggesting right now, that the downside is certainly where, is the path of least resistance. And until we see that proven otherwise, I think that's how you want to approach this. So I think, if you're trying to position long here, I think, being tactical or just being light in your positioning, tier 1 or half position size, is certainly the way to go. Again, there are individual names that are outperforming, and there are those that are underperforming what these indices are doing. The indices are showing at some points, perhaps a very biased picture here with some of the big caps really, accounting for a lot of the makeup here in the SPY. Energy was down huge today, so it is interesting. We'll get into some of that sector analysis in a little bit, but I think you certainly need to be cautious here. If you look at a weekly chart, you can see we're basically challenging right now on this bigger time frame all of the support from earlier 2015. 198 to 199 is where this market found support for several months, and that's an area that is very important for us to hold on to, because there is, again, just layers of supply that are sort of getting added above us. If we continue to trend lower, it's going to be really difficult to start to change that course and break, and eventually turn ourselves higher. So from a bigger picture, we're certainly in just this messy range. We've been in it for quite some time, for quite some time. Perhaps this is a big topping pattern. Perhaps it's consolidation for the next move up. Again, we don't know that just yet. But on a weekly time frame, in the context of a long-term bull uptrend, we are range bound right now, and we're in the middle of that range. And that typically is just going to mean that trading is going to be very difficult and more or less choppy on some of these smaller time frames like the daily chart. Now, if we look at some other indices, the IWM, the Russell, so here we are challenging some very big support right now. If you go back to a weekly chart, you can see this is a level that has held as support since roughly 2014, since the beginning of it. We had a brief breakdown below it in late 2014, but more or less the market has been above this 108 area, 106 area for multiple years now, and we are closing right into that. 3.6% down this year so far in the small caps. It's only been 3 days of trading, but this is a very important level, and if the small caps start to break down below this level, that's going to be very troubling for the spillover effect and what the other indices like the NASDAQ, like the S&P do if the small caps can start to lead to the downside. So that's something to keep on watch. I think this area right here where we closed at, we want to see the buyers kind of step in. We are oversold. We're a bit stretched here in the small cap. Again, it doesn't mean we have to just bounce furiously, but we are pretty stretched from the 20 period EMA and lots of other ways you could certainly measure it. So I would expect maybe some consolidation here, but for now, very clearly the bears have the momentum in the small caps, and similar here in the Qs, we are breaking below support. Again, you can see us below 109, which was holding for November and December of 2015. We're below that. Buyers tried to at least rally us a little bit. We closed off the lows. That's mildly constructive, but we do still have this gap here from the new year above us. We got the fast moving averages racing higher. So if this is a breakdown at highs, and as we were range bound here for a few months in the Qs, that again is troubling and is a bit concerning. The weekly chart, again, still very messy here, and we definitely need to reclaim 110 if you do want to be constructive, if you are a buyer of this market or individual names within this. You do want to see us get back above 110, get back above the previous range. Maybe this turns into a false breakdown. That's certainly the ideal optimal scenario there for the bulls. Now, getting into some other markets, TLT, seeing a bit of rally here. It's been consolidating really tight in between 120 and say 123, 124. Still a messy chart. Again, looking at the weekly chart here, it is a pretty healthy range now that has been developing. I think getting back above 125 would make it for a really nice kind of breakout continuation pattern in this long-term trend. So let's see if we get that over the next couple of days or weeks. But for now, TLT starting to firm up. I like the way it's been kind of just moving sideways throughout here, and it's not quite ready yet, but something I am watching. USO, this one beaten up. This was one of the headlines today, down 5.16% on the day. This is multi-year lows, 7-year lows, I believe, or thereabouts. Support has been broken. The trend remains lower. The fast-moving averages are racing lower. It's just nothing that you want to try and bottom pick. I think there's just clearly too much momentum to fight this. You want to be either short or on the sidelines. UNG, this one now has shown some signs that these prices down here perhaps overreaction. We saw a sharp move off of these $7 lows or sub $7 prices from late December. Let's see if the bulls now can hold us up and not give back this recent rally. So it had a nice $1.50 rally. You want to see it at least, holding this gap would be ideal. So holding $8, getting back above or holding above here, going sideways and then making a move higher, that would be constructive. But what you don't want to see is us just start rolling right back over in the direction of this long-term downtrend. I think that that would be troubling. You'd want to continue on your shorts or avoid this, if that were the case. But for now, looking mildly constructive right there. Silver and the metals. A little bit better today. Gold in particular up 1.5%, getting back above this prior support level at 104. Was support in August of 2015, held up as resistance in late 2015, and now we're trying to break back above it. So that is constructive. Perhaps this is one big false breakdown, sort of consolidation pattern. If you look at the weekly chart, again, the trend on the long term is still lower, but you do see us trying to work back above, breaking above what could be this resistance level, and that is mildly constructive there. So keep an eye on gold. Silver, not quite as bullish. It hasn't broken above this $13.75 level. That would be the equivalent. We want to see silver get back above here to start getting a lot more constructive. Now, if we look at some of the sectors here, IYR is holding up well, all things considered. This one down 33 basis points today, but look at it kind of banging its head against the $76 resistance level. It's been range bound now for for 6, 7, 8 months already. But look at this nice potential bottoming pattern here, maybe an inverted head and shoulders, if you want to call it that. On a weekly chart, you can see we've been consolidating here. If we can get back above 76, I think you do see some more rotation there. It is starting to shape up there. Same thing with the XLU. It's range bound, not quite as constructive from a technical standpoint, but still only down 18 basis points. So these are outperforming relative. And then the staples are still holding up pretty well. Again, 34 basis points to the downside. It's trying to hold above 49.75, which was a recent breakout area from back in December. Let's see if it can continue to hold that. But the consumer staples really close to all-time highs. So that's certainly constructive there if you're looking for long ideas. On the downside, I mean, pretty much everything else is getting hit, but in particular, technology is rolling over. It's very similar to the Qs, the technical picture that we looked at earlier. Semiconductors really hit hard here. Certainly overextended now on the downside. Maybe it can pause, base out, or rest a little bit before continuing lower, but right now the trend looks to be reversing here in the semis. XLY, the discretionary sector, again, this is rolling over pretty hard today, down 1%. Buyers stepped in a little bit, but breaking back below this key 77 in change area is not too good there going forward. And then materials also rolling over pretty hard today as well. So those certainly the laggards when looking at the bunch, but really aside from the rate sensitive sectors, there's not too much that's looking very constructive going forward. Now if we get into some individual names, we'll run through these quick. Apple testing that big $100 level. Zoom out, you can see it's breaking below this it broke below this 106 level on a weekly chart. This has been, this has been a mess for a while. If repeatedly for the past few weeks, at least months, been saying that there's just better setups out there. It's been messy and it's been slowly breaking down. Looking like maybe this is some type of head and shoulders pattern here as well as far as topping pattern goes. However you want to look at it, it's below what was support now, which you'd expect to be resistance. The fast moving averages are above price, racing lower. It's definitely an avoid or a short, until proven otherwise. This is just something you need to be careful with. Google, this one still holding up, all things considered. It's had a pretty impressive day, down 0.29%. Buyers stepped in. Constructive, as far as on a relative basis anyway, but it is still holding above this area here, which has found support now for a couple of months. Keep this one on watch. Not ready yet for anything, but I do like the slight outperformance here. Definitely still a leader. Google is, so keep an eye on that one. Amazon, not quite as constructive. You can see this one is breaking below what was previously support, so below that 640 level. The fast moving average is racing lower now, so something you want to be careful in. Again, only closed down 18 basis points, so let's see if this one can quickly bounce back above this 640 level. That would be constructive. Facebook was positive here as well. So these kind of three horsemen here, all very similar kind of technical picture. They've been the leaders now for quite some time. They've been basing sideways for most of November and December. Facebook closed positive. still at a pretty challenging level. Really needs to get back above, I'd say at least here back above 104 to get back into this range, and then ultimately back above 107 to start breaking out to new highs. So something that just needs some time right now. It is trying to stay resilient. Let's see if they can continue to keep it resilient going forward. Tesla down 2%. This one's been getting beat up. It broke back below 230. This is an important level. It's still just range bound here between around, call it 210, 235 or so. Until it breaks out one way or the other, I think it's just going to be a lot of chop and headaches inside this range. So be careful if you're trying to trade Tesla. GoPro, this one's actually holding up. I mean, it's been absolutely slaughtered here for the second half of 2015, but now it's trying to move sideways here. It's trying to finally catch its footing. Maybe the selling pressure has finally dried up, and maybe GoPro can make a run at retracing some of this recent damage. But closed mildly down today. I think you got pretty clear support right around 17 and a quarter to down to $17, and then the resistance right up around $20. We had that big gap up yesterday. It was faded very immediately and very quickly. So still not ready yet. You could see it tried to get going yesterday. It failed. So keep an eye on this $20 level moving forward. Maybe GoPro finally starting to see some type of a turnaround there, at least for some type of near-term retracement. And then finally, Alibaba, this one gap down is still in effect here. So the gap from the first day of the year is still holding. We closed down 1.65% today. So, we're holding the November lows down here right around $75, but you want to see those continue to hold going forward. Looks pretty vulnerable, but it is still holding up from its recent trend higher starting back in October. So something to keep on watch. And then finally, Twitter making new lows here again, breaking down from support, down 2.5% today. Still just a very ugly picture here. Fast moving averages still racing lower. We're basically at all-time lows minus this, this flash crash type of day here back on August 24th when everything went crazy in the morning. So, for all intent and purposes, this is all-time lows for Twitter, and something you should, be cautious of if you're trying to step in and buy this. Really need to see us get back above at least 23.30 to start getting a little more constructive. And that's what I have for names today. No trade ideas. A lot to handle here just with the opening 3 days of the market. Things are pretty stretched, but let's see if we can catch some type of rebound tomorrow, or if the bears will stay in control and head us lower. And actually, the last thing I didn't think I mentioned earlier is this nice gap here that's looking like perhaps this could be some type of magnet here over the next few days to next couple of weeks here, down around 195 to fill that gap. Maybe that's what the market's heading to. If you're big into that, then that's something to keep on watch. But that's about it. As always, thanks for watching. I will catch you next time.